Good evening and welcome to Fonti International. Tonight we're going to focus on equity markets and we're going to do a follow-up of the Theresa May Plan B for the Brexit. Before we go ahead, let me remind you that the US markets are closed today, honoring the Martin Luther King. Although we are going to analyze later the banking season that we had in the last week, there was a little bit of relief for the banking sector that closed in the negative territory in 2018. Last week, the major banks posted positive profits, though in terms of fixed income, there was some delusional data, but we're going to talk about a little bit later. Let's first take a look at how the European markets closed today. We have most of the indexes in the negative territory. Unfortunately, the German DAX closed in the negative territory, down by 0.62%, CAC 0.17, FTSE MIP negative by 0.35, and the only one very interesting is that it's the UK FTSE 100 closed in the positive territory by 0.03%, sorry. The Pan-European Stock 600, as I said, sank 0.26%, with most sectors and major bourses in the red territory. As I said, market players monitor news of slowing growth in the world's second largest economy, China. And the Chinese gross domestic product in 2018 grew 6.6% from the previous year, in line with analyst expectations, but at its most sluggish rate in almost 3 decades. Let's go to the single shares. Telecom Italia share price declined following news that the domestic communications regulator turned down its plan to spin off its landline network. Orange, meanwhile, dropped 1% after the company disputed reports that it's mulling a bid for Spanish competitor Euskaltel. Looking at individual stocks further, German chemicals firm Henkel slumped to the bottom of the Stock 600 after it released preliminary financial results and said it would hike investments by around 300 million euros. The stock slipped 9.7% by the mid-afternoon. On the other end, Air France KLM rose to the top of the European index, and after Davy Research updated the stock to outperform from neutral. Shares were almost 10% higher by the afternoon. In corporate news, online food delivery company Just Eat also fell, unfortunately, after it said Chief Executive Peter Plum would step down and update earnings guidance. Of course, all eyes were on Brexit, but before we go ahead, let's see how the Asian markets closed today after the news that China announced its official economic growth came in at 6.6% in 2018, the slowest pace since 1990. That announcement was highly anticipated by many around the world amid Beijing's ongoing trade dispute with the US, its largest trading partner. Economists pooled by Reuters had predicted full-year GDP to come in at which was down from a revised 6.8% in 2017. Fourth quarter GDP growth was 6.4%, matching expectations. That was a decline from the 6.5% year-over-year growth in the third quarter of 2018. Let's see how the Asian markets closed today. They rallied, all of them, because at the end, even though we had a lower results, they are still pretty good, because 6.6% of growth is pretty much good, though. We had the Japanese Nikkei up 0.26%, Shanghai positive 0.56%, Hang Seng positive 0.39%, and the South Korean Kospi positive 0.02%. 2%. But let me focus your attention now on the event of the week, which is the World Economic Forum in Davos that is going to start actually tomorrow. The topic of the World Economic Forum 2019 is Globalization 4.0, shaping a new architecture in the age of the fourth industrial revolution. As we can see by the photos, those are going to be the global leaders, one of the most important politicians in a global level that are not going to attend the event. Theresa May, crushed by problems, she introduced today the Plan B Brexit. On the other side, we have Trump. He cannot fly because of the shutdown that is continuing for 30 days of partial government shutdown. More than 800,000 workers are not working, or they are working without taking any salary. And on the right, we have Emmanuel Macron, the French president. He is also covered by problems in the protest between the Yellow Vest and the government. Though the World Economic Forum kick-started with the International Monetary Fund press conference, Christine Lagarde, the managing director of the IMF, confirmed there is a global slowdown, but not a global recession. Let's hear more details instead from the IMF head of research, Geeta Gopinath.
At 3.5% in 2019 and 3.6% in 2020, that is 0.2 and 0.1 percentage point below last October's projections. Now, the downward revisions are modest. However, we believe the risks to more significant downward corrections are rising. While financial markets in advanced economies appear to be decoupled from trade tensions for much of 2018, the two have become intertwined more recently, tightening financial conditions and escalating the risks to global growth. We have revised downwards our forecast for advanced economies slightly, mainly due to downward revisions for the euro area. Within the euro area, the significant revisions are for Germany, where production difficulties in the auto sector and lower external demand will weigh on growth in 2019. And for Italy, where sovereign and financial risks and the interconnections between the two are adding to headwinds to growth. The US expansion continues, but the forecast remains for a deceleration with the unwinding of the fiscal stimulus. Across advanced economies, we foresee growth to slow from 2.3% in 2018 to 2% in 2019 and 1.7%.
Well, we've heard that there is a global slowdown, but not a recession. So still there is not so much or let's say too much to worry about, because Christine Lagarde also emphasized the fact that we are still not going to recession, despite the German auto sector is very much worrying the IMF because it closed in the very negative territory in 2018, and there are not really positive landscapes for it in 2019. Also, Italy, a huge problem for the European Union, and not only at the global level, and not to mention the US problems between Democrats and Republicans, because as I said before, the partial government shutdown continues more than 30 days. This is absolutely a record for the US history, but not only modern, for the history as a whole. If it continues till March 1st, there may be very serious economic repercussions for the US. We are going to follow this event certainly in a very detailed way, but let's go ahead with the Brexit, because it's the hottest topic here. It's one of the topics that is worrying the entire world. The British Prime Minister Theresa May revealed today her plan B for Brexit, trying and hoping of winning over lawmakers who overwhelmingly rejected her proposals last week. A key point to her withdrawal deal is an agreement to ensure no hard border returns between Northern Ireland and the Republic of Ireland. Some Brexiters feel that backstop could be used by Brussels as a means to keep Britain within the EU, while the Northern Irish Democratic Unionist Party, or the DUP, is nervous it would lead to Northern Ireland being treated differently from the rest of the UK, which is a huge issue. In a statement to the lower house of Parliament this afternoon, May said she should now discuss with the DUP on how to ease fears among the people of Northern Ireland before returning to negotiate further with Brussels. However, May said the prospect of a second Brexit referendum did not enjoy majority support, and also rejected the growing calls for her to rule out a no-deal Brexit as a possibility. The right way for this House to rule out no deal is for this House to approve a deal with the European Union, she said. In what appeared to be some small concession to opponents, May said her government would also guarantee that workers' and environmental rights would not be eroded post-Brexit, and that a £65 fee for EU nationals applying for settled status would now be abolished. May said she would continue to hold further meetings on Brexit next week and hope that opposition leader Jeremy Corbyn would held talks with her. Prior to the statement, sterling sat at 1.28 versus the dollar and rose to 1.2819 as she spoke. Let me remind you that Parliament will now debate Monday's statement from the UK leader before a vote on the motion is taken on Tuesday, January 29. So we have pretty less time because it's only the next week. Let me see if I have Jean Ergas, Tigress Financial Partners on the line. Jean, do you hear me?
I hear you very well, thank you.
Good evening, Jean, and thank you for joining us tonight.
My pleasure.
Well, Jean, as we've heard, Theresa May tried to convince lawmakers in her Plan B, but it's not really a positive, the reaction, because we followed the discussion between the Parliament and Theresa May. So what we felt is that they do not really agree on her Plan B, and there are not really many differences compared to Plan A. Where are they heading to? Where is UK heading to?
That's a very good question. I really always thought from the beginning that, in fact, this Plan B was going to be a Plan A slightly tweaked for two reasons. First, because there are certain issues which simply cannot be accepted by many of the lawmakers, and that is the customs union or some form of single market. This will go dramatically against everything that the Leave contingent voted for. And secondly, I would say very explicitly, it's because the EU is the one that also has to decide. This debate has hitherto been framed as simply the UK lawmakers speaking to each other, coming to a conclusion, and then going ahead and voting it. There's something wrong here. There's a very important person here, the other tennis player, the EU. We are playing a doubles game, so to speak. And I think we have to be in sync. They have to be in sync. And they are not in sync. So I think it's really going to be extremely difficult. The real issue, of course, is more than simply voting and several times, like some people have proposed, let's vote type battleships to see where we get the hit and where we get the most consensus. The real problem, our issue, I think, was the second referendum issue. And now this seems to have been ruled out. I think the fear in the UK is that the second referendum would undermine a basic belief in a majority rule, the electoral process, and would set a dangerous precedent. Now, that said, it seems that there's a 12% majority now, and the majority of 12% over what is required for the Remain contingent. Many people have rethought their position. But there are some constitutional issues here, I would imagine, and some difficult issues of procedure. So I think at this point, the best that can actually happen is that somehow, A, these people wake up to the fact that the deal is better than no deal, and that no deal will lead to tremendous amount of disruption, and it will lead to an immediate crash in housing prices. The reason I'm talking about the housing prices is very simple. Is that in the United Kingdom, a house is most people's pension plan, and if that goes, they are dead. So I think there's going to maybe be an attempt now by May to go to Brussels, come back with a little bit of a tweak, maybe some slightly different side letter wording for the famous Irish backstop. Remember, the Irish said they are not going to do a bilateral deal. The Irish are not going to conclude, so to speak, a separate peace with the UK. So now it really is in the hands of the EU. I think at the end it's going to be, listen, it's this or, guess what, either no Brexit, which I think was very difficult, or no deal, and you will immediately see a large part of your wealth fritter away or collapse overnight.
And on the other hand, as a senior economist, what are you mostly concerned about? What do you believe, which is going to be the sector that is going to suffer the most in case of hard Brexit?
Well, I think they're all going to suffer. I will tell you immediately. The one I think is really going to get slammed is the domestic economy. Okay, let us look at the distinction between the external economy and the domestic economy. First thing that's going to happen is that there will be an absolute block, I think, on domestic investment. And this is obviously going to cost jobs. It will also stop the wealth effect. It will also hit the housing sector, which is very important as a consumption driver wealth effect. Two, there's going to be a devaluation of the pound. This devaluation of the pound will result in imported inflation, which will further squeeze domestic incomes. So we're going to be seeing this acceleration effect of increased inflation, falling house prices, falling wealth effect, shrinking economy. Who will come out maybe the best of it? Possibly companies which have extensive earnings from abroad and which they can repatriate at a far more advantageous FX rate. But I think we're going to be looking at butchery on the internal front. This is going to be very, very, very complex, because then something else is going to happen. To counter the inflation, the Bank of England is going to have to raise interest rates, which is going to disproportionately hit those smaller companies which cannot access the capital markets or international bond markets, but are reliant on bank financing, which is a very quick pass-through from Bank of England decisions. So I think it's not an attractive scenario. Now, I'll put it to you very simply, as we have often said. There are two choices now. One is managing decline, which is some sort of deal Brexit. The other is disruption and collapse, which is the no-deal Brexit. There are people who claim that you can actually have a no-deal Brexit without disruption by a series of side letter agreements on essential services. This in no way guarantees the smooth functioning of the British economy. You will be managing by exception, and there will be areas of non-clarity, which could be quite dramatic, such as, for example, in the pharmaceutical sector. So I think that in the end, people, I hope, with my hope, will come to their senses and say, look, let us choose the lesser of two evils. Second referendum, it's always there, and the general election issue has not gone away. So remember, I think some people might actually think at some point, maybe I'll accept this deal if not I'll end up with Jeremy Corbyn. I was in the UK in the 1970s, and believe me, I saw what the radical Labour did. So it's a sobering thought. I think it's a very difficult situation.
Well, Jean, I would like to ask you another question. Currently, the sterling against the dollar is literally rallying. It's up by 18%. It's at 1.2895. It's one of the highest levels. Are you surprised about that?
Sorry, can you repeat your question? What currency is?
The sterling against the dollar. Are you surprised?
Sterling, okay.
Are you surprised
yes,
it's currently rallying?
Yes, no, sterling. I'll tell you about sterling. First of all, sterling, I was in the UK exactly a year ago, and sterling was 140. Okay? And the dollar was roughly where it is today versus other currencies. So in fact, if we're looking at sterling in those terms on a one-year basis, exactly, we have seen a sharp depreciation of the pound. The sterling has come back from below a 125 level. What the market tends to be saying in FX is, listen, we think there's going to be some kind of a deal here at some point. We may even, now the other question we didn't talk about was the extension, and Mrs. May is adamant there's not going to be an extension, but we know how politics is. And the market is saying, look, we're going to come to some kind of a deal. The market has ruled out, I think, erroneously, the prospect of a no-deal exit. It's like people ruled out that Lehman Brothers could go bankrupt. I myself was in Monte Carlo at a very big risk conference just before they went bankrupt. Nobody solemnly assured me that this was impossible, and I expressed my doubts that they were right. So I think this is basically it. What I think is interesting is if you look at the UK bond market, okay, and that in fact people are buying longer dated bonds. And what this tells us is that they believe there's going to be a lot of disruptions in the short term. This is a classic sign of country risk increasing. Okay, so I think this is a very important point. We're looking at two different markets. We're looking at the currency market and we're looking at the UK gilts market. And the gilts market is signaling danger, and the currency market is saying, well, look, in the end, they'll muddle through. So I don't think that sterling is that strong, quite frankly. If I think it was 151 when this happened, it hit a minimum of about 119. I think there was a flash crash. It hovered around the 139.40 for a long time. Now we're at 128. We're still below 130. I don't think that sterling is that strong. I still think that sterling, compared to then, I still think that sterling is not taking into account the risk of a no deal.
Right, Jean, I would like to focus your attention on the US because there is a lot going on there. We are at the 13th day of a partial shutdown. It's more than a month now that more than 800,000 government workers are not taking their salaries. First of all, I would like to ask you, Jay Powell said that he would be worried for the economic impact if it lasts till 1st of March. But are you starting to be worried? Because from what we've seen, there is no really much of green light from the Democrats regarding the border wall. So what is your opinion? Are you already starting to be worried about the impact on the US economy, and do you believe those people are going to be paid sooner or later?
Look, I've been worried all along because I started from the assumption that Trump is campaigning. What is actually taking place in the U.S. now has very little to do with the border or non-border in and of itself. It has a lot to do with getting reelected. When the people decide that they need to get reelected, economic rationality goes out the window and political rationality takes its place, and this is a very different game. I think that there are some noises now of maybe coming to some vague form of agreement. As regards economic impact, I'm convinced that there will be one. I think it could be up to 1 to 1.5% for the first quarter, not only because these people were not paid, so they did not receive their checks, so they could not buy things, but also because of the fact that a lot of business must transit through government services or checks, and these had not been done, and therefore this has slowed the course of business. So I think it's a very important point. I think, yes, it could have an impact, but I think the real point will be the loss of credibility. And to finish, I would say, yes, I was saying before, I think there are some vague noises we are hearing. It is based on semantics and not on substance. It is based on saying, well, let's not talk about a wall, let's talk about barriers. Let's maybe give another $1 billion, but we'll tuck it in somewhere else. And there it is. I think that Trump has realized that Nancy Pelosi is a very tough cookie, and that it will not be easy to push these people around. And then, in fact, people are now starting to think, look, whose fault is it that this thing is just dragging on? So I think, yes, there is going to be an impact. The question is, will there be a snapback? This is it. Government shutdowns have tended to have an impact, but had a very quick snapback. This one has been long. How quick will the snapback take place? This is the issue, and I think we may have to wait. I am a believer that growth is slowing globally, and it will slow as well in the U.S., and this is not helping.
Well, Jean, on the other hand, we had last week the bank's earnings season, so there was a little bit of relief for the banking sector, because I say relief because it closed 2018 in the negative territory. Most of the banks posted positive profits and also revenues, but I want to underline that Citigroup fixed income revenue dropped 21% year over year to $1.94 billion. And most of the banks, most of the counterparts of Citibank had a very low fixed income. So why is that in your opinion? And first of all, and secondly, how do you interpret this data that we had?
Well, I think the first point is this. Let us look at the banks as an indicator of the economy as such. I don't think they are. I think that the banks are playing to a very different, marching to a different rhythm, which is regulatory, and it's also based on the shape of the yield curve. And that's the traditional, what can do, and the profitability of the basic lending business. When we start looking at things such as fixed income, we are no longer looking at traditional banking business, we are looking at trading business. And trading business can be influenced by a number of factors which have very little to do with economic reality. It can be, for example, a drop in volatility, it can be a shift in asset allocations, a shift in investment strategies. So I think I would not look at the bank so much as the indicator. The banks are interesting only in as much as a very poor performance from a bank or undercapitalization or a very sharp rise, unexpected in bad loans, could be a monitor signal for systemic risk. But let us not confuse the banks with the cyclicals and with the big companies which are the pulse of the economy much more. I think the banks are neither here nor there and tell me very little about the real march of the global economy. I am much more focused on the macro cyclicals, point of sale, commodities, purchasing manager indexes. I think that's where the key is.
Well, Jean, let me ask you one last question because we are unfortunately out of time. China's economy grew 6.6% year over year in 2018, the lowest pace in 28 years from 1990. Do you think 6% growth is still feasible for Beijing in 2019?
Look, the question is, what is the real growth rate in China? I do not believe it's 6%. If we strip out basically artificial growth, which is being financed by bad loans, i.e. loans from the government which will never be repaid, and which are basically fictitious companies, I think growth is more probably around 2%. So I think that's how we have to look at it. The growth rate official is what the government wants it to be. The government will get that growth rate at what cost? Of increasing the bad loans and creating a problem in the credit system. I think that the country is slowing. I think that, in fact, we have seen the creation of the first wave of the middle class. I think this process is coming to a gradual halt, and I do not believe that China will save the world again. I think we have to get used to the fact that there's going to be a soft landing at some point in China, and this growth rate will naturally decline, and they also have demographic problems. Therefore, we cannot look to the Chinese consumer as we once looked to the U.S. consumer to be our rescue.
Right. Thank you very much, Jean Ergas, Tigris Financial Partners. Thank you very, very much for joining me tonight.
It was a pleasure and an honor. Thank you.
Good evening.
Bye. Cheers.
Well, we are going for a short commercial break, but we are going to be back in few minutes.
Ben ritrovati in diretta dalle Fonti TV, Forex Time.
L'analisi dei principali cambi valutari. Quali i movers della settimana in grado di influenzare euro, dollaro, sterlina, yen, cripto? Con Alex Soldati e le vostre domande da casa ai migliori analisti e operatori del settore. Forex News, da lunedì a venerdì alle 15 solo sulle Fonti TV.
Ciao, sono Andrea Melo e questa è una contabile.
Dal 2003 Andrea è un trader professionista. Fino al 2013 ha lavorato per 2 fondi proprietari. Dal 2015 ha aperto una sua società di advisory per clientela istituzionale e privata.
Che cos'è una contabile? La contabile è un documento bancario che certifica i guadagni e le perdite di un conto corrente o di trading giorno per giorno dalla data della sua apertura. Le contabili sono il curriculum di un trader. Io ho deciso di far parlare loro per me mostrandovi il mio ultimo anno di operatività. Come vedi, queste sono appunto le contabili dell'anno. Siamo partiti, appunto, abbiamo fondato il conto al 15 di marzo e c'erano 85.350 euro. Poi settembre il conto è andato a 110.000, quindi ancora fatto un altro 2% abbondante in più, per poi finire al 15 di marzo, quindi dopo un anno esatto di operatività, il conto era tornato a 119.000 euro. Quindi, ricapitolando, recap, 15 marzo 2017, saldo di partenza 85.350, e poi siamo arrivati, dopo un anno esatto di lavoro e di fatica, al 15 di marzo 2018, 119.000.
Il conto di Andrea è partito il 15 marzo 2017 con un valore di 85.000 euro ed è arrivato, dopo 12 mesi di operatività, il 15 marzo 2018, ad un saldo positivo di 119.000 euro, con un drawdown massimo del 9%.
A questo punto vi starete chiedendo perché ho fatto vedere le mie contabili, perché ritengo che quello che qualifichi un trader professionista siano i suoi risultati su denaro reale. A questo punto cosa posso fare per te? Se vuoi diventare un trader professionista, condividerò con te il mio know-how attraverso un percorso didattico semplice ed efficace. Se vuoi sapere di più, ti invito a visitare il mio sito meloandrea.com e cliccare la sezione Trading Experience. Se sei tra coloro i quali non sono più soddisfatti della propria banca o del rapporto col proprio promotore finanziario, ti invito a visitare il mio sito meloandrea.com alla sezione Financial Advisory oppure il sito elitassetvalue.com.
Good evening and welcome back to Fonti International. After our short commercial break, let me remind you that the US stock markets are closed today in honor of the Martin Luther King. I would like also to remind you that we are now in more than 30 days of a partial government shutdown, really critical situation in the United States because more of 800,000 people are not getting paid more than 1 week. Let's see how the European markets close today. We are going to go just for a fast checkup. The European Stoxx 600 slipped 0.26% today, with the most major indexes in the negative territory. We had the German DAX negative 0.062%, CAC around 0.70%, FTSE MIP negative 0.35%, and the only one that traded in the positive territory, incredibly but true, is the FTSE 100, up by 0.03%. Let's go fast to take a look at the Asian markets, how they performed today. They literally rallied. We had Nikkei up by 0.26, Shanghai Composite positive 0.56%, Hang Seng positive 0.39, and the South South Korean KOSPI positive by 0.02%. Let me remind you that China announced that its official economic growth came in at 6.6% in 2018, in slowest pace since 1990. That announcement was highly anticipated by many around the world, and Beijing's ongoing trade war dispute with the US, its largest trading partner. Economists polled by Reuters had predicted full-year GDP to come in at that pace, which was down from a revised 6.8% year-over-year in 2017. Instead, fourth quarter GDP growth was 6.4%, matching expectations. That was the decline from the 6.5% year-over-year growth in the third quarter of 2018. So not bad, but not really also good. We are not going to recession. It's a simply economic slowdown all over the world. I would like to focus your attention on the event of the week, or the World Economic Forum in Davos. The World Economic Forum 2019 topic is Globalization 4.0, shaping a new architecture in the age of the fourth industrial revolution. Very interesting event. I would like to remind you that the major figures like Trump, Emmanuel Macron, and Theresa May are not going to participate in the event. The World Economic Forum kick-started with the IMF press conference. Christine Lagarde, managing director of the International Monetary Fund, confirmed there is a global slowdown, but she emphasized that this is not a global recession. So it's very important to understand. I would like to make you listen more details by the IMF head of research, Gita Gopinath. Take a listen.
At 3.5% in 2019 and 3.6% in 2020, that is 0.2 and 0.1 percentage point below last October's projections. Now, the downward revisions are modest. However, we believe the risks to more significant downward corrections are rising. While financial markets in advanced economies appear to be decoupled from trade tensions for much of 2018, the two have become intertwined more recently, tightening financial conditions and escalating the risks to global growth. We have revised downwards our forecast for advanced economies slightly, mainly due to downward revisions for the euro area. Within the euro area, the significant revisions are for Germany, where production difficulties in the auto sector and lower external demand will weigh on growth in 2019. And for Italy, where sovereign and financial risks and the interconnections between the two are adding to headwinds to growth. The US expansion continues, but the forecast remains for a deceleration with the unwinding of the fiscal stimulus. Across advanced economies, we foresee growth to slow from 2.3% in 2018 to 2% in 2019 and 1.7% in 2020.
Well, let me remind you that some of the triggers for the global slowdown are the potential no-deal Brexit, and on the other hand, the Chinese economic slowdown, and not to underestimate the US-China trade clashes that are currently in some pause. As we know, the 90 days pause between Trump and Xi Jinping. They are talking and trying to find an agreement regarding the trade war. Talking about a Brexit no deal, let's go to Theresa May, because today she revealed the plan B for her to her government and also Parliament that overwhelmingly rejected her proposal last week. A key point to her withdrawal deal is an agreement to ensure no hard border returns between Northern Ireland and the Republic of Ireland. Some Brexiters feel that backstop could be used by Brussels as a means to keep Britain within the EU, while the Northern Irish Democratic Unionist Party is nervous it would lead to Northern Ireland being treated differently from the rest of the UK. In a statement to the lower house of Parliament this afternoon, May said she would now discuss with the DUP on how to ease fears among the people of Northern Ireland before returning to negotiate further with Brussels. However, May said that the prospect of a second Brexit referendum did not enjoy majority support, and also rejected the growing calls for her to rule out a no-deal Brexit as a possibility. The right way for this House to rule out no deal is for this House to approve a deal with the European Union, she said. In what appeared to be some small concession to opponents, May said her government would also guarantee that workers' and environmental rights would not be eroded post-Brexit, and that a £65 fee for the EU nationals applying for settled status would not be abolished. So, pretty complicated situation, although the sterling is absolutely rallying. It's at 1.2919 against the dollar, and Parliament will now debate the Monday statements from the UK leader before a vote of no motion is taken on Tuesday, January 29. So we have only 1 week before the vote of Theresa May's Plan B for the Brexit withdrawal agreement. Let me see if I have my second guest on the phone. Avramis Despotis, CEO of Tradepedia. Good evening, Avramis. Are you there? Okay. So we have some technical problems. Let's take a look once again at how the EU markets closed today. We had most of the major index in the red territory. The German DAX down 0.62, CAC negative 0.17, FTSE MIP negative 0.35, and very surprisingly we had the FTSE 100, despite the pressure on it, positive 0.03%. Let's see how the telecommunications sector performed. We had the Telecom Italia and France Orange dragged down by the likes of Italy's telecoms. Telecom Italia share price declined following news that the domestic communications regulator turned down its plan to spin off its landline network. Orange, meanwhile, dropped 1% after the company disputed reports that it was mulling a bid for Spanish competitor Euskaltel. Looking in individual stocks, German chemicals firm Henkel slumped to the bottom of the Stock 600 after it released preliminary financial results and said it would hike investments by around 300 million euros. The stock has slipped 9.7% by the mid-afternoon. On the other end, Air France KLM rose to the top of the European index after Davy Research upgraded the stock to outperform from neutral. Shares were almost 10% higher by the afternoon. In terms of corporate news, online food delivery company Just Eat also fell after it said Chief Executive Peter Plump would step down and updated its earnings guidance. Meanwhile, traders await Brexit Prime Minister Theresa May announcement regarding her Brexit deal Plan B. Let's see how the Asian markets performed instead. We had absolutely a rally. Nikkei was up by 0.26, Shanghai 0.56, Hang Seng positive 0.39, and the South Korean Kospi positive 0.02%. This rally was because of the positive GDP data of the positive Chinese GDP data at 6.6 year over year and 6.4% for the third quarter. We are going for a short commercial break, but we are going to be back in 2 minutes.
Asset Management, New Insurance, le due trasmissioni dedicate al risparmio gestito e al mondo assicurativo. Innovazione tecnologica, evoluzione degli scenari, cambiamenti negli stili di vita. L'industria del risparmio gestito, delle assicurazioni e la distribuzione finanziaria stanno cambiando. Quali sono le nuove organizzazioni, i nuovi prodotti, le nuove politiche? Con i giornalisti di Le Fonti e gli ospiti in studio, Asset Management e New Insurance si propongono di approfondire l'evoluzione in atto dovuta all'innovazione tecnologica e all'apertura dei mercati e di analizzare le normative che riguardano il risparmio gestito e l'attività assicurativa. Asset Management, New Insurance, solo sulle Fonti TV.
Good evening and welcome back to Le Fonti International. After the short break we had, let me remind you that today the British Prime Minister Theresa May revealed her plan B for the Brexit before her Parliament that overwhelmingly rejected her proposals last week or only 1 week ago, and then 24 hours later it voted for her and saving her from a no confidence vote triggered by the opposition leader of the Labour Party, Jeremy Corbyn. Fortunately, I have on the line Avramis Despotis, CEO of Tradepedia. Good evening, Avramis, and thank you for joining us tonight.
Good evening, Alexandra. How are you?
Fine, thank you very much for being with us. I would like to start with the Brexit because it's the hottest topic in Europe currently, but also in a global level, because today the International Monetary Fund said that it's very, very concerned about a hard Brexit because it's the first time that the world is dealing with something similar, so they don't even know how to react on it. It slashed the growth for 2019, but first of all, I would like to ask you, what is your forecast regarding FTSE 100 in particular, and which are the sectors that we have to avoid, and do we have to avoid it as a whole, or instead do you see good deals buying in a lower price now?
Well, okay, so in UK we are walking into uncharted territory. No one really knows what is happening. There seems to be some positive news from what I've been listening around, that the fear of no deal seems to be taking over in Europe, who might be willing to compromise on the Irish border story. So, for example, the Polish foreign minister has suggested that the Irish border issue could be solved if the backstop were time limited to 5 years. So you see that there is something starting to change, and Europe starts to be afraid of the no deal scenario. So they might be willing to compromise, and we might see a compromise in the days and weeks to come, which of course is going to be converted into a nice rally in the stock market, yes? However, I just believe that this is going to be a bear market rally. It's going to be a relief rally that will take us a bit higher to then start a long-term bearish market. So I don't really see, of course there is a short-term opportunity to enter, but the general direction of the market is bearish, strongly bearish, I would say.
So you expect a bear market on FTSE 100?
Oh yes, I expect a bear market actually all over the globe, as we saw in an interview we did together a while back.
Although US markets absolutely rebounded at the very beginning of 2019, and on the other hand, FTSE 100 is the only one, I show you, that closed in the positive territory today by 0.03%. Instead, all the other European indexes closed in the negative territory. Are you surprised by that?
Well, no, not really. I mean, all the rally we saw since the beginning of the year was totally anticipated. The markets were oversold. They reached the important support levels. So the rally was not only expected, was welcome, because now it will give us the opportunity to sell at a higher level. Of course, the markets now, let's say the Asian markets, they corrected a little because of the GDP of China, which was at the lowest level in the last 28 years. So this is definitely giving jitters in the world stock markets. I mean, okay, no one should complain for 6.5% growth, especially in Europe.
Absolutely.
But,
yeah.
but definitely it's showing that there is a slowdown in China, and this is worrying stock markets and the economies everywhere.
And on the other hand, we are seeing right now the sterling is literally rallying. It's up by 0.12% against the dollar, 1.2885. Are you surprised by that? Why is this positive reaction?
Well, as I am saying, there seems to be a positive momentum in the bear market rally that we are seeing now. So I would expect this bear market rally both on the sterling and the FTSE and the stock markets to continue higher, because it seems that there's going to be maybe a compromise between the UK and the EU. So they will try for another compromise, and this is what is helping the rally. But this is going to be temporary, of course. Let's not forget, especially in the European market, like DAX, which is my favorite market, too short. You know that since 2008, with all the austerity measures that we had in Europe, we sort of lost the GDP of Spain. This is the amount of GDP that was lost in the European Union because of the austerity measures, and this is taking its toll. I mean, we have seen all the results that we had in November. Germany is going down, Italy is going down, I mean, their GDP and their results. So the economy, especially in Europe, is actually not doing that well. I mean, industrial production in Italy, Spain, and Germany went negative in November.
No, absolutely. In fact, this Thursday is the meeting of the Governing Council of the ECB. Do you expect some more specific monetary refinancing measures in order to support the banks like TLTRO, or you do not expect some important monetary policy decisions to be taken?
You know, usually the ECB is a bit more slow to react. So I'm not sure that we're going to see any reaction this coming week. If we do, it would be a surprise, but then again, things, as we said, are not doing well in Italy, Spain, Germany, all over Europe. So they have to act. I'm not sure that they are going to do it fast enough and big enough
to
stop the coming recession, if we might say.
I would like instead to focus your attention on China. As we've said, the economy grew 6.6% year over year in 2018. It's the lowest pace since 28 years or 1990. So, I mean, do you think 6% of growth is still feasible for Beijing in 2019?
No, I mean, of course, we have the unknown factor X, which is called Trump. Okay, so he can help keep it, or he can destroy it. The volatility in the decisions that are being made is well known. So if they do manage to find a solution between them and the trade war, so they negotiate a trade truce, the tariffs are lifted, China opens market access and clamps down on intellectual property theft, all these things are definitely going to help. But then again, I still find it very difficult to maintain these levels. I mean, the trend is clearly down in the growth in China. Things are not that rosy, and you know, we are a global economy now. So with Europe going into recession, it's also bad for China. Then we have the oil, which is not that high. So this affects the consumption in the Middle East, which in turn affects China.
Let me ask you one last question, because we are a little bit out of time. I would like to know, what is your forecast regarding the tech sector in China? You know, they are so much competing with the US, with the US tech giants that closed in the very negative territory in 2018, but then in 2019, at the very beginning, they had an absolute rebound, an absolute rally. We know that the Microsoft, Apple, and Amazon are the majors, let's say. But what do you think about the Chinese tech sector? It's absolutely competing pretty well. The Tencent, the Huawei. What do you believe, especially after the Huawei problems with its CFO Meng Wanzhou?
Well, definitely the Chinese tech sector is taking the US one-to-one, and they are doing really well. And I think one factor that you may not have mentioned, but is indirectly related to this, is the fact that there is less iPhones being sold in China, and instead we have the local brand outperforming the international ones. So definitely they are going to give technology firms in the US a run for their money in 2019.
I see. So you expect the Chinese to prevail at some time over the US?
Well, yes, it would seem so, and this is all related. You know, we have the story with Canada, we have the tariff and trade war. So maybe someone is seeing something not so good for the US company.
Right. Thank you very much. Avramis Despotis, CEO of Tradepedia. Thank you for joining us tonight.
My pleasure. Thank you so much.
Have a good evening.
Bye-bye.
Well, this was everything from us. Thank you for having watched us, and see you tomorrow exactly at 6:20 p.m.